Hi everybody, my name is Griffin Bridgers. Today it's my pleasure to introduce a recent private letter ruling, 2022-06-009, which had some very interesting points that you may not always see in a private letter ruling. Now, while the scope of this may not apply to everybody, it's a very narrow type of transaction. Its breadth could be far-reaching in terms of who it might apply to in the estate and gift tax transfer planning world. So we're going to dive into this private letter ruling, but for the time being, keep in mind that the actual substance of this dealt with a situation where there was a transfer of employer securities by sale to an ESOP, an employee stock ownership plan. And then the proceeds were used to buy qualified replacement property, which was then transferred to a grantor trust. So I know it's a mouthful, but we'll look at how this is actually applicable as we go through. So to start with, as I mentioned, this is an interesting private letter ruling due to the fact that it didn't just address the immediate transaction, it also had somewhat of an anticipatory application looking ahead to what might happen at the taxpayer's death. So, as I mentioned earlier, a grantor trust was involved. Now, this wasn't the usual grantor trust that you'd see. They didn't really come right out and say expressly that it was a revocable trust, but they did say that the grantor had the power to amend or revoke the trust, in addition to a bunch of other powers that would usually be consistent with a grantor trust, like the power retained by the grantor to direct the trustee, to withdraw trust principal without substitution, and even to retain a reversionary interest in the trust, which they didn't expand on much. We don't know if that's a reversionary interest that exceeds the 5% threshold to treat it as retained ownership, but nonetheless, the assumption we can make on these points is that this was the type of trust that would likely be included in the grantor's gross estate for estate tax purposes, which isn't addressed at all in this private letter ruling, but will factor into one of the other anticipatory rulings that the IRS made, which I'll mention at the end to close us out. Now, what initially happened? Now, what was in question was Code Section 1042, which isn't necessarily as important here in terms of the actual substance of this transaction, as I mentioned, because it's rare you'd have this type of situation, but 1042 really deals with a situation where you have qualified securities, which are essentially original issue securities issued by an employer that are publicly traded, which are then sold by a taxpayer to an ESOP, and as long as that sale occurs and the ESOP owns 30% or more of the outstanding securities of that corporation, and so long as the taxpayer who made that sale reinvests those proceeds into qualified replacement property within 12 months, you can defer your gain on that sale, much like you would with something like a 1031 or something like that. This is really a capital gain deferral technique when you sell appreciated employer securities to an ESOP. Now, we're not going to get into the technical details of how you qualify within this because those are kind of extraneous to the actual discussion today. Because what this PLR didn't do is it didn't explain whether these basic requirements are met. It just assumed that they did, including the qualification of the replacement property. So the PLR started with the assumption that this was qualified replacement property, but typically, to have qualified replacement property, you have to have stock in a different domestic operating corporation whose passive income doesn't exceed 25% of its gross receipts. So, setting that stage, we can now step away from the whole issue of this ESOP transaction more into the meat and bones of what we explored, because the PLR had assumed that these requirements had been met, and what it was really looking at is, when is there a disposal of that qualified replacement property that would require a recognition of that deferred gain, or a recapture of that deferred gain, as the statute says? And that's really where this grantor trust came into play, because what the taxpayer was seeking was the IRS's blessing on a subsequent transfer of that qualified replacement property to the grantor trust in question, which, as I mentioned, looked like a revocable trust. So what the IRS ruled is that, there are recapture provisions under Code Section 1042E3, which don't require recapture of deferred gain if there is, say, a transfer by gift, or under a reorganization, or a transfer at death. But all of those could have applied, especially the gift exception could have applied, but because this is a grantor trust, Revenue Ruling 85-13 essentially says that the grantor and the trust are disregarded and treated as one entity. So what the grantor is doing here is really just selling or transferring the property from themselves to themselves, because the assets of this grantor trust are treated for income tax purposes as if they're the grantor's own assets. So the IRS said we don't even have to get into those recapture exceptions like gifts or anything like that, because this is a disregarded transaction to begin with. So because of that, the statute doesn't even apply. Really we're just extending Revenue Ruling 85-13 to this situation. So that's kind of the natural outcome and what you'd expect here. But there were two really interesting points I found that followed this within the private letter ruling that you might not always see with this type of thing. One is a lot of people might miss this. The taxpayer represented within the private letter ruling that they intended to maintain grantor trust status perpetually. Now, supposedly this is designed to give some reassurance that there's going to be no immediate subsequent application of the recapture statute. But either way, while that representation probably didn't factor into the immediate ruling, it had some trickle-down effect, I think. And one must consider on a surface level whether that's even really a necessary factor disclosure that you need to make when you're seeking a determination involving a grantor trust. Which brings us to interesting point number 2, where the IRS typically just looks at the immediate transaction, but in this case they extrapolated it forward, presumably based on this representation, and said that if the grantor trust status was maintained until the taxpayer's death, what that means is that the recapture exception for transfers at death by the grantor would apply. So at that point, the grantor trust status terminates at the grantor's death. So at that point, there is a transfer due to the death of the grantor. Now, there's a whole other side debate on the effect of such a transfer on the step up in basis and everything like that. And usually what that debate centers around is the fact that a lot of grantor trusts are set up to be intentionally defective, such that they're not includable in the grantor's gross estate for estate tax purposes. But this ruling was important because although the IRS didn't expressly state this, it did tee up this argument to say that since this trust would likely be included in the grantor's gross estate under the facts we previously discussed, like the right to revoke, the right to withdraw, so on and so forth, what that means is that down the road, that qualified replacement property would qualify for a step-up in basis at the grantor's death under Code Section 1014B9, and thus all that deferred gain could potentially be wiped out at the time of the grantor's death. Now, of course, there's a cost to that. There's gross estate inclusion and possibly some estate tax, depending on what the exclusion and applicable credit look like at that point. But nonetheless, that is an interesting thing you don't often see in private letter rulings, that anticipatory type of ruling looking ahead. Thank you again for listening to this presentation. As always, if you have any questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But thank you again for listening to this video, and I look forward to seeing you in my future content.